So anyway, I'm long. I'm now starting to kick them out. I'm breaking even, losing a little money. I'm kicking them out. Okay, now you could have bought more puts up here at 25 cents. Okay, that's possible because, hell, if we can't go up, there's a shot we go down. Anyway, I'm kicking back most of my S&Ps. I buy, and guess what? I buy some more. We're down here actually a little below the 40. Okay, let me get rid of this. We don't need this right now. We're actually below the 40. We're testing this low. Okay, and I figured maybe time of day can start here. Guess what? Exit again. Meanwhile, my puts are working their way towards 45, 50 cents. So if you bought some more at 25, 30, you're not doing too badly. Now this is ugly. Now we're starting to make, and I'll draw some of these things on. I'll just give you an idea. I'll just draw these on so you get some idea of what changed. See? This changed. See? We stopped the uptrend line, came back to the back side of it. See? This is really neat stuff. I draw a tremendous number of trend lines on the charts. We broke the uptrend line. We're coming back down. Now I'll get rid of that, and I'll move to a new trend line here. Okay? So we have a new trend line. Again, down. We have 2 points. We can put a trend line on here. Now we're failing. Now I try again. That's a nice reversal bar. And guess what? We're coming into getting oversold. Doesn't work. Got to kick it out. Lose a little money on the longs I rebought. Meanwhile, my puts are now 55, 60 cents. I'm starting to get the put money back. Okay? Then guess what? We take out Orbo, opening range breakout. Support. Support is now going to become, but I'll try it again. I'm retesting this low with a 60% of the day's retracement. I should get some lift. Okay, so I start scaling back into my, meanwhile, my puts are increasing in value, 60 cents, 65 cents. Okay, so I'm making money with the puts. You're now long some extra puts, so say instead of 100, you're long 150. You have $1,200 invested in 50 of them. It's going to allow you to do a lot more hedges when the market turns. That's the only reason you're buying. You're looking to hedge. So I'm buying, I'm losing money, losing a little money, my puts are going up in value. Okay, now I come in here, I go, okay, I got to buy them. I'm now down to the 80. I'm now oversold. I got to pile into the S&Ps. I got to buy a ton of S&Ps down here. So let's say you're long 150 options. You can buy anywhere, start scaling in. You can buy anywhere between 50 and 75 S&Ps. Okay? And guess what? Wow, I rally 2 points. Well, 2 points on 50 S&Ps is $5,000, guys. 2 points on 7,500 is $7,500. That's a lot of money. Meanwhile, you paid for all your puts. Again, you paid for most of your puts when you sold them out here, the S&P. Okay, you lost a little money, but don't forget your puts are going up in value. Now here, I blow out all my puts. Okay, for whatever reason, I figure maybe we're close enough. I mean, they go back to like 40, 50 cents. I'm gone. You know, I didn't sell them out here. I bought the S&Ps. I wanted the protection. Okay, because they're around, 60 cents. Okay, they're about a point and a half out of the money. 60 cents, 2 hours, 2.5 hours to go. Point and a half out of the money. That's noise. We're trading 7-8 point ranges. Okay, I kick them out here. Blow out all my S&Ps here. Blow out all my options. And now I'm waiting for things to happen. The market comes down. I'm thinking it's going to hold. It's going to hold a low. So I start buying S&Ps back in here. Okay. Start buying more S&Ps. And I did tell the room they should hold their puts. I did sell them out, but I told the room they should hold their puts. I should have bought. In hindsight, I should have never sold my puts out here. Because now there's 70 plus cents. So you can be blowing them out here. So if you had 150, that's worth 10 G's. I mean, it's not bad. You doubled your money. What you paid 55 cents for, or now 40 with the lower price. You doubled your money on the puts here. Now here is a gigantic level. This is a 40 going back to 214. Okay, it's a retest failure to low. It's within the low window. Okay, here the low is 37. Here the low is 36 and a quarter. So we're piling into the S&Ps. We're piling in, retest failure, and we're jammed. Okay, now we're jammed here and here. We come down and make a lower low. We kill for bars like this. This normally in 10-point ranges tells you going up 3 to 5 points. We kill for these bars. Now look at what happens here. We have leading divergence, jammed. Now jammed, up or down, and we go back to the 35 or 44, coming down from the 108, going down to 62. That's leading divergence. So what happens is price goes back to a lower low, and the oscillator is a third of the way up the page. That's called leading divergence. In the new manual, we have 5 kinds of divergences. In the first 2 books I wrote, we had 1 divergence. We traded all. There are divergences we don't trade against. Okay, that's the book that differentiates all the types of divergences. Here's leading divergence. Price is going higher. Leading divergence. Guess what? Pow! It pops up 3+ points. Now let's say you have 150. You're now long 75 again. Okay, you blow it out up 3 points. Guys, that's 10 grand. There's 5 grand. There's 7 or 8 grand here. There's 5 grand here. 10 grand here. You know, now you can buy more puts if you want. You could have sold them all out here. Okay? All right, so now you get short again. Here, I'm selling all my E-minis again. I'm out of all my E-minis again. That's a tremendous trade. 3 points, you're long. Normal trading, about 10 contracts, maybe 15. Big trading hedged, you can be long 100. You can be long 70. The puts are now at the money, selling for 70 cents. At the money. When we do hedges, when we do at the money options, we can be hedged as much as 75%. We always want to leave room to make more money in case the market falls apart. Okay, and the reason we don't sell puts up here, we could have walked away from the entire trade up here, lost $2,000 on the options, made $9,000 on it, we made 7 grand. We could have quit. But the reason we don't sell the puts, one, they're too cheap. We want to keep them because we have 3 or 4 hours left of hedging time, playing time. We don't know what's going to happen. Let me tell you something. You don't just hold the and blow out your options because you're losing money. What if the Iranian ships going through the Suez Canal, one had a dirty bomb on and blew up? The Suez Canal is now shut down for 25 years. Oil's $200, the market's down 1,000 points, and you have puts, you would have got wiped out if you were long S&Ps by yourself. Stops wouldn't have worked. You'd have been blown out. Okay, so these are the kind of things you want to keep in the back of your mind. You always want to be hedged because it prevents a catastrophe. Yeah, you can lose 2 points, 3 points. But beyond that, that's it. That's the most you can ever get wiped out. So you want to hold those puts. You want to really be using those puts. Now you can sell out. There's nothing wrong with 25 cents to 70 cents. That's a great trade. But you want to do this hedge. You want to do this hedge with 50, 75 S&Ps. That's killer. Now it goes back down. You go, oh, gee whiz, look at this. Still got, I'm not in the low window here, though. So you can buy them. Market goes back up. It fails. Now look at, this is support, became resistance. You can see, started selling in here, became, and now we have a little downtrend line, still resistance. So we're getting out. Okay, you buy, again, you get out. See, sticks. We're not closing generally above the downtrend line, a new downtrend line I drew. Then we come down. Guess what, guys? We're now in the low window. We're in the low window. This is a point and less than a point and a half away. And if you want to just do bodies, it's right at the low. See, I generally do breakouts and stuff, opening range breakouts. I do across the body, not necessarily across the peaks. So if we did, and I'll show you what I mean, if we did this, that's pretty damn close to support. Okay? So you want to be a buyer, and you want to scale in. Same thing now. Start buying 10, 20, 30, 40, 50, whatever you're buying, because you can have the puts. The puts are back to 50 cents. You can even buy the puts at 50 cents here, protect yourself, and go long the S&Ps. Now when they break out here, now you're off the, now look at this. This you got to take profits. When you see this kind of bar, you're still not taking out resistance. Still not taking out resistance. Support becomes resistance. Now we're breaking out above that, so we're looking, and everybody now is on the wrong side. They can't, late in the day, we have a trade called end of day, 3:30, end of day. If they can't keep making the newer trend, which is down, if you can't keep taking out and making lower lows, just like you stop making higher highs, okay? Here, you can't make lower lows. I already wrote the down was over here. The down's really over here, buying the E-minis back. Look at this, 38 to 43, 5 points. $250 profit. The options go out worthless. Who cares? You just, let's say you have 75 S&Ps, 50 S&Ps, 10 S&Ps, whatever you just made $250. Make it easy. 100 S&Ps. You end up with 200 puts. Okay? You end up 200 S&Ps. Guys, that's $25,000. And you lost, let's say you had 200 options. Let's say it cost you 50 cents. You lost 10 grand. This one trade just made you 15,000 net. And the bias is up. You know you. And the only reason you do the puts is because you stop trading 2 and 3 and 4 S&Ps and you now start trading 10, 15, 20, 100. So in these narrow ranges, when you get 2 points, it's serious money. It's serious money. And you don't have to worry about the downside. My God, you're risking 70 cents. Shit, that's noise in a market that's trading 5, 6 points. Okay, so you lost your money. You lost your $10,000 on the who cares? You just made $25,000 on the S&Ps. You made $15,000, whatever it is. You made 9. You made another $5,000. You made $10,000. You made $25,000. Hell, you only paid $5,000 to $10,000 for the options. That's what I'm trying to show you is there are so many possibilities. And believe me, I said it before, no one's done all this. I mean, I left. I left here, left here. I left a lot of money on the table. But the point being is you're not trading in 2-point ranges, 3-point ranges. Normally what the move is, you get a move up and then the market does this the rest of the day. But each of those 2-point range trades, 3-point range trades, you're now talking about $1,000, $5,000, $10,000 a pop. And you're buying on Friday these options that are 30, 40, 50 cents. That is the greatest game in the world. I mean, it's incredible. And when you put all the tools together, the 127, you're watching the ADs, retest failure, time of day, the oscillator, leading divergence, okay, support, resistance. And you have someone who's been doing this for 28 years, really 49, but 28 in the S&P pits and here. You get some idea. Now, I'm not perfect. Look, I didn't get in here and buy 500 more puts at 25 cents. I didn't blow out all my S&Ps. No, I was normal. I was playing the game, got long, recognized I'm wrong, started getting out, okay, got out of all them and started buying them back again. All the time making money on these trades. All the time making money. Made money on my options, made money on the S&Ps, made money on the S&P. Guys, this is the only way you're going to be able to handle. You're going to learn to trade like a professional. It takes time, guys, but this is a lifetime achievement. I mean, I've been doing this I ran a hedge fund for 10 years. I mean, you've got to be proactive. This is how you make money with your money. You don't ever have to do anything more in your life. This is what it's all about, guys. Hey, look, have a great holiday. I want to thank you and have fun. And welcome aboard.